Traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, I'll just run through a few key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is really to break down all the market jargon and complexities that we read about and you guys take in from multiple sources of information, no doubt. But if you do have any questions around what we talk about for the next half an hour, 40 minutes or so, then please do ask them along the way, and I'll hope to answer them as we go, or at least after the webinar finishes. It's Wednesday, February the 8th, so let's get to it. Markets at the moment generally quiet after, of course, last week's multiple risk events. A super busy week really last week, so the calendar has inevitably slowed down slightly in terms of data and scheduled events. Highlights already have included the RBA meeting. We'll touch on that later. Of course, we got Fed Chair Powell's speech last night. And then going forward, we have the postponed German CPI data for January out tomorrow, and then we have the UK GDP data to finish off the week on Friday. Markets really digesting Friday's unbelievably strong US jobs data, that headline non-farm payroll figure, 517,000. We'll go into those bits of data, those numbers shortly. But the themes generally, there had been or has been an increase in tensions between the US and China, obviously on the discovery of this spy balloon, and then the US Secretary of State Blinken cancelling his trip to China. The kind of relationship between the West and Beijing obviously appeared to be on some improvement track really, at the same time as China's reopening of the economy was happening. So that has taken a bit of a dip, and risk markets responded to that on Monday at least. But then certainly since then, we've had Fed Chair Powell's speech, which we'll get into shortly. Probably the biggest FX impact, market impact this week has been Monday's reports in the Nikkei about the next BoJ Governor, as current Deputy Governor Amamia has apparently been approached by the government to assume that position. This choice really seen as likely to extend the central bank's ultra easy monetary policy. He's really seen as a dovish continuity candidate who is very close to the departing governor, Kuroda. And the initial reaction was certainly bullish for bonds and weighed heavily on the yen and local financial stocks. Ultimately, markets may need to recalibrate their expectations for policy normalization that we saw after the shock December's decision to tweak, if you remember, yield curve control, tweak that trading band, and that really illustrated the shockwaves that any hint of Bank of Japan policy change can trigger. It sent the yen sharply higher, Japanese yields rose sharply, and treasuries lower. So what is the result of this potential announcement? Traders really pricing in an early withdrawal of stimulus could really pull back those wages if markets expect a delay in any policy tweaks. And we can see on the dollar yen chart here, I've just got pulled up actually, you can see, well, the breakout from the non-farm payroll figure, that upside break out of that bearish trend channel. You can see from sort of middle of November, quite nice channel, probably extended further out from the top above 151 as well. There's a channel there, series basically of lower highs and lower lows, but then that breakout after non-farm payroll up to the light blue line 50-day moving average around 132.35, and that sort of capped the upside really. Now you can see in dollar yen, and we've fallen back really on Fed Chair Powell's speech. The halfway mark of the 2022 rally actually is at 132.70 as well, so that kind of reinforces that resistance above, and then we've just fallen back now to sort of 130.77. You can see there, top of this channel may act as some support around 129.60. Otherwise, obviously the trend is for lower prices in dollar yen. Really interesting then with this potential announcement of Amamiya, and potentially I think the announcement of the nominee actually happens on Friday this week. That goes to Parliament, and then the nominee is then ratified by Parliament and would take over obviously when Kuroda finishes, which is until April. Big mover has been for yen strength, especially after that December tweak, that shock change, where many thought there would be policy normalization going forward, especially obviously with the Bank of Japan being in a world of its own really compared to every other central bank, which is obviously hiking rates and has done. And even though that policy hiking cycle is sort of nearer the end, still Japanese interest rates, of course, government bond yields are very, very low in comparison. We'll see what happens there, and definitely something to keep your eyes on. For equities, I'll just pull up the charts, the S&P charts. We think, well, actually two things to note really. Firstly, we haven't looked at the VIX recently. Worth looking at this. This tracks, of course, investors' expectations of volatility over the next month. It's kind of nicknamed Wall Street's fear gauge. And that has pretty much fallen since the start of the year. And now it's below its long-term average of 20. It has been for 2 straight weeks. And that is actually the longest stretch of low volatility since the start of last year. The VIX tracks investor expectations, as I've said, of volatility over 30 days. The actual VIX for the 1 year, so which tracks expectations of stock market swings over the next year, that actually touched its lowest level since the onset of the pandemic. So a drop in the VIX really leads some funds to increase leverage and add exposure to stocks. So interesting really how low this is, sometimes used as a contrarian signal really when we're so low that we should see some sort of spike in volatility. But at the moment, you can see we're well below sort of 20, below 19, and below that long-term average, as I said, of 20 or so. Just one other thing with equities, interesting that we're kind of getting in some of the analyst reports, some of the press as well, financial media anyway, sort of rebirth of phrases like FOMO. FOMO, if you remember, fear of missing out. And that's to do with stocks and to do with obviously the S&P 500, the benchmark US index now being up around 8% since the start of this year. Tech heavy Nasdaq, that's probably rallied around double that, so around 16%. And if you remember, those indices were down by a fifth and a third respectively last year. That's the S&P and the Nasdaq. Really decent bounces, fear of missing out by a lot of fund managers. We've seen other risky assets, and certainly those beaten up really most in the sell-off last year now being the best performers. So you've got Bitcoin, for example, jumping over 40%. You've got Cathie Wood's ARK Innovation Fund, very well known really, dominated by high growth tech. That is up around 45%. Closing on 50% actually, I think. So certainly there's a lot of cash on the sidelines after last year's sell-off, and it's created kind of a bit of a conundrum as funds really don't want to miss out on this rally. But that said, the market is kind of behaving as if we're on the other side of a recession that hasn't even happened. Friday's jobs figures, of course, they kind of have seen markets be quite choppy as well. We shouldn't forget the market has generally been trying to fight the Fed, really. They've been confident that they think inflation will come down sharply, and really then the risk of a recession or a policy mistake or even a second wave of inflation, that's really now an afterthought. And then we've seen this idea of this Fed pivot, and that's kind of just taken a slight jolt, obviously, with those job numbers, and then with Fed Chair Powell's speech yesterday. Surprisingly, really didn't push back on what he said after or during the press conference last week at the Fed meeting. Many were expecting him to be more hawkish last night, but he probably delivered the minimum amount of pushback against dovish speculation required by that strong January jobs report. There was kind of ample room really for him to surprise on the hawkish side, and he kind of was fairly sanguine again, really. And it clearly seems that he's reluctant in a way to drop that stance really on this disinflation narrative that a lot of funds, a lot of algos, a lot of the market are focusing on, when he obviously said about the disinflation process has started now. That's really got everybody's interest, and we'll touch on that very shortly. Actually, we'll just run into the Fed meeting, the main takeaways from that. But of course, he still mentioned last night, just on that speech, that potentially the Fed will have to hike higher than expected if we see more decent jobs data. Just on the S&P 500 then, let's just look at that on a technical basis. We can see, yes, we moved above, obviously, the that sort of zone of resistance that we probably mentioned before, 4,000 level or so, that falling trend line, the 200-day moving average now at 3947, and you've got the 50-day moving average now crossing above the 200-day moving average. That pattern, some of you will know, is called a golden cross. That's where, so the 50-day rises above the 200-day moving average. That happened on Thursday, in fact. Just a few stats on that. So since 1950, the S&P 500 has produced an average 12-month return of 10.5% after a golden cross formed. The average overall annual return since 1950 is 9.1%. That's according to LPL research. But when a golden cross has appeared as the 200-day moving average is declining, as it is now, then that average 12-month return actually jumps up for the S&P 500 to 16.8%. So a couple of stats there to take note of. Yeah, technically then we went past an upside target that we had, the sort of December pivots there around 4,100. We've now got the September high at 4119, and then the late August highs at sort of 4,200. Around here you can see support then those pivot highs around 4,100, and interesting then whether we can break above 4,200, and then we're looking really at these sort of mid-August highs around above 4,300 then. For us, if we go to the weekly, we'll just pull back and you can see that long-term fib level really acting as support, and probably if we just drop in the next fib level, sort of more minor one if you like, but that's 40, just around 4,200, so another potential sign of or a level of resistance there. That grey line is the 100-week moving average, bang on 4,200 really. So interesting point whether this is just bullish consolidation in this nice uptrend that we've seen from that sort of December consolidation, if you like. Steady uptrend really. Again, series of higher highs here, higher lows. Whether this small pullback, then we see a push above well, last week's high at least at 40, what was it, 41.95, and then a push up to sort of potentially 4,300 if this uptrend carries on. In the Nasdaq, similarly, a big bounce from those December lows. We got quite close to the big fib level that we have, which is 12, just below 13,000. If we pull up the weekly, actually, you can see that better. So that's the 38.2 of the 2020-2021 rally, really. So 38.2 fib is at 12,947. So just above where we are now. We didn't quite get there last week, 12,880. That high, so potentially that will act as some resistance in the near term for the Nasdaq, and then you've got support around the halfway point, 11,768, as well as that falling trend line. That was trend line resistance, obviously now would be trend line support potentially, and that maps sort of the 200-week moving average a bit lower, 11,616. 200-day moving average, we should say, for the Nasdaq 100, sort of just below that high from mid-December, the 200-day moving average at 11,947. That's on the Nasdaq. One index we wanted to point out as well is the booming, the surging FTSE 100, the UK FTSE 100. That hit an all-time high on Friday, actually, and now you can see we've gone above that really now. So an all-time high, 7,890 on the FTSE 100. The previous peak was back in May 2018, and really interesting. We've risen probably over near 7% now this year, I guess, after ending up actually nearly 1% higher last year. So that made a FTSE 100 the best performing developed market index in local currency terms. And with the FTSE, we shouldn't really, we want to highlight just two things, I guess. It's dominated by multinational companies. So there's little drag of the domestic economy as that heads into recession. And many of those multinational companies, of course, they book the bulk of their revenues overseas. So any falling sterling valuations, devaluations, certainly against the euro and the dollar since Brexit at least, over that time period, then that certainly helps those big multinational companies. And those are really oil companies, miners, banks, insurers, utilities, and really the index lacks sort of high growth tech names. And in the past, maybe that's been a vice really, but now at the moment anyway, it's seen as a virtue. Certainly as inflation and rising rates have squeezed those tech valuations and really pushed investors to potential stores of value. For example, I think Shell, that was up 43% last year. Great big oil company, of course. Second biggest company on the LSE, longest London Stock Exchange. HSBC even, obviously big banking conglomerate, up 15%, I think, last year, boosted by obviously higher interest rates, boosting profits. So yes, still really decent long-term bullish trend really, or medium-term bullish trend from really those mid-October lows at 6,700, just above there. Now we're pushing up towards 8,000. If we just go to the monthly, we drew on some sort of levels. You can see that May 2018 high, which we just pushed above, and then we've got last month's high as well, and then we drew a level from January actually last year, and we sort of pushed above those resistance lines really. So really we're then looking at round numbers, to be honest, as we're into sort of blue sky, if you like. 8,000, probably a key level, key psychological level, if we are to then sustain this move higher above sort of 7,900 or so, which capped the upside. You can see at the start of this month, really. Interesting levels for the FTSE, and again, remember, heavily exposed to multinational miners, oil companies, and banks for sure. Okay, let's move on now to non-farm payrolls. Last week's non-farm payrolls, at least. Let me just pull up a couple of charts for you to look at, or graphics actually. Firstly, obviously, just all the numbers. Blowout headline, 517,000, huge shock for January. Kind of everything seemed to be pointing to declines in job creation. Remember, the previous print was 189,000, and instead we ended over 500,000 new workers. That's really unusual. January's number is normally lower, and the number was actually obviously sharply stronger than we've seen at any point in the decade between the GFC actually and the onset of the pandemic. I'll just look at a couple of those charts in a minute, but all the numbers you can see, 10th straight beat, highest reading since July. Interestingly, and we'll go into this, wage growth 0.3% month on month, and the annual figure fell from 4.8% to 4.4%. But then, sorry, we had a dip in the unemployment rate below estimates and dropping to multi-decade lows. And this really sort of all with this decent, really decent 3 month annual, 3 months, sorry, job gains, even if you look at the 6 months, obviously propelled by this massive number, with revisions as well in December and November, really calling into question then what we've seen markets supposing. Of course, Chair Powell touched upon this yesterday, but again, those hawkish sort of the hawks hoping for more hawkish rhetoric from him were disappointed, really. He wasn't any more hawkish, and he was ultimately less hawkish than many were expecting. He did touch upon the NFP report, obviously saying if we see more of those, but certainly one report, he wasn't swayed at all by that for the time being. Just on those couple of charts I was going to show you, there you can see obviously that strong January print. Not seeing anything like that since obviously GFC and the onset of the pandemic, as I said. And then on the right hand side, these charts certainly they exclude, just to note, the extreme COVID months. On the right hand chart, interestingly, Bloomberg, sorry, 1 second. Bloomberg prints publishes the range of estimates in its survey of economists each month, and generally the final number doesn't exceed the most optimistic estimate very often, and if so, by not very much. And if we leave out those, obviously those difficult pandemic months, if you like, which skew the data, make this better reading, better, more legible, then it's actually only the second time the rise in payrolls has topped the highest estimates by more than 200,000 in 25 years. So that's how big that number was. Certainly, there have been questions over the validity of the data. Obviously, seasonals potentially playing a part as well, and we'll have to be very careful for certainly next month, start of next month, of course, and February's data. But going forward, It kind of seems that there's fewer laid off and not any big increases in hiring. That's sort of one reason potentially for that big jump. So there's fewer layoffs yet, and yeah, as I said, not massive increase in hiring. And then also going forward, we've got sort of business surveys. We need to pay attention to those. For example, the conference board survey of CEOs and the small business surveys. They're kind of really on their lows, quite depressed, near sort of or on a par with sort of GSC numbers in 2008 and below pandemic lows in some of those business surveys. So will be interesting to see what happens going forward with that headline figure and then potentially also revisions. I did touch upon the wages element. That is one part certainly that that doesn't or is showing moderation and not overheating. So that is encouraging for the Fed, and certainly then that will be it's still high, of course, but it has continued to decline a little. And that's probably the single most direct way in which a tight labour market can tip into more inflation, and that's, as you can see, didn't move significantly. Though I say it's too high probably for the Fed's comfort, certainly high enough to deter probably any rate cut. So just with regard to the labour data, then obviously it's a key theme for the Fed. It puts pressure from high demands from wages at the centre of its battle against inflation. Generally, of course, if employment is weakening, that should be a sign that the medicine is working, bring down price pressures, and then readying for those cuts. But for the most part, then that's obviously not happened with this report. How does the Fed react? Well, as we've said a couple of times then, Chair Powell still sanguine, still relatively relaxed compared to some thinking in the market that the Fed will be higher for longer. That means, of course, they keep rates higher for longer, and we have seen the terminal rate, so that's the peak rate in the Fed funds rate, go from sort of 4.9 below 5% now up to sort of 5.1, 5% or so. So that's just above, if you remember the dot plot, the average dot plot that we saw in December, and it will be interesting what happens going forward. Also, we need to remember, I think, that employment numbers are backward looking. They're a classic lagging indicator. So in a way, maybe January's surprising surge, you know, has sort of been looked through slightly as well. And really, it's kind of better to sometimes rely on forward-looking data. We did see that last week. We saw that in the ISM surveys of supply managers. This chart here, you can see for manufacturing was pretty miserable. As you can see, new orders point to recession risk. You can see below 50, way below 50, and yeah, pointing to recession risk in manufacturing. That was published actually before non-farm payroll. And then on the flip side, we had ISM, the survey for the services sector that came out an hour and a half after the NFP on Friday, actually, and that really painted a booming picture, actually. The survey's been running since 1997. It's only ever once increased by more from month to month, and that was actually during the pandemic. So we're kind of seeing, yeah, different sides here. There's a slump in manufacturing and a boom in services. So interesting stuff for the Fed to look at going forward. Just touching then on the Fed meeting briefly, important to sort of review that in a way, just because obviously, as we've said, Chair Powell stuck to his line. Obviously, the Fed unanimously decided to raise rates by 25 basis points. That was the second consecutive downshift, of course, after those multiple 75 basis point hikes. The last one being in November, then we saw 50 in December, and now 25. Probably the key things for us, Powell, he did seem to prepare markets for a potential change in dot plots going forward by making them data dependent. So that all relies on fresh reports, of course, of hiring, of inflation and activity before the next meeting in March. Also then on inflation, he mentioned for the first time, and we've mentioned this, the disinflationary process has started. That was pretty big for markets, and that acknowledgement of that fact. And then also Powell, when it comes to the unwanted easing of financial conditions since the previous meeting. So what does that mean? That means a weaker dollar. That means sort of lower bond yields, stable bond yields. It means stronger stock markets. Powell refused to push back on that against the softening and said that the Fed's focus is not on short-term moves. A real big surprise for many, but he stuck to that. And again, really that stood out for us. And then also finally, really, he painted a picture, really, a near Goldilocks picture scenario, really, where inflation can come down while unemployment does not have to rise. Again, a standout comment, really, because markets, we've been focused on either a soft landing or a hard landing, and now really we're getting people trying to be clever, really, and saying there will be no landing. So yes, we shall see. Obviously, non-farm payroll headline figures are sort of jolted markets, put them on warning. It's raised that terminal rate, as we said, 5.15% or so. So potentially there's some room there. If the Fed goes above 5% in quarter point moves, then it would be up to 5.25%. So another 10 basis points that the market can go higher. That means Treasury yields go higher and no doubt give some support to the dollar. If we just look actually at the dollar chart, the DXY chart, that's obviously the index of the dollar against 6 of its major trading partners. You can see here the DXY. So yeah, bump up from that low, the low just below 101, you can see there. And then we've just sort of been capped by resistance. We've been in this, well, we've put 2 levels out for a while now. Hopefully you remember those. 102.99 is the pandemic spike high, you can see there. And then we've got this high from January 2017, actually, 103.82. So we think they're long-term levels to pay attention to. And at the moment, you can see that, yeah, they capped the upside. We sort of bobbled around there, if you remember, in December as acting as support. Then we broke lower, and now potentially they're acting as resistance. We shall see. You can see the long-term, oh, sorry, medium-term downtrend, really, from the October highs, September highs, actually, in the dollar, as then we've had this sort of alternative to the dollar, which has played out, obviously, with China reopening and lower gas prices, the better European outlook. So the DXY, yeah, capped by the 50-day moving average at 103.51 potentially, and then this sort of zone of resistance potentially 103, 102.99 up to 103.82. So really interesting to see where we go here, whether this long-term or medium-term downtrend really persists, and certainly if we break below yeah, 102.99 really is key support. If that doesn't work, then we roll over and we probably go potentially down to 102 again. Okay, also this week we've had the RBA just focus on that. We've got the Aussie dollar here. Really interesting. They raised their policy rate as expected by 25 basis points. So that was in line really with consensus. That took the policy rate up to 3.35%. That's the 9th consecutive rate hike since the normalization tightening cycle started in May last year. But the RBA sounded really more hawkish than in December in its closing paragraph. It now expects and it signaled more rate hike increases are on the way. They'll be needed over the months ahead to ensure that inflation returns to target and that this period of high inflation is only temporary. Interesting, in December, the bank said it was not on a preset course when it comes to additional tightening. And another addition was a reference that if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later. And that's quite interesting because it's sort of commonly flagged actually by central bankers at the moment, i.e. it's better to take the risk of over than underdoing their tightening. The RBA then mentioned stronger than expected core Australian inflation numbers in an otherwise probably pretty more balanced economic assessment, basically high inflation against weak growth. But the hawkish plots in the statement, they really helped the Aussie dollar sort of from these lows. Interesting for the markets now, they price in a peak rate. We are at 3.35% now. They price in a peak rate of around 3.9%. That's from 3.6% before the RBA announcement. And there are projections by some local Australian banks that we hit above 4% in the second quarter. Interesting then for the Aussie dollar, that potentially makes it the most attractive currency in the G10 in the months ahead if the RBA continue to raise. Really all about that inflation data domestically, and then certainly outside, of course, the US-China relations, that will be a concern. Certainly because Australia has been on track to easing trade tensions with Beijing, sort of back end of last year, certainly. And then yes, China reopening, of course, that is something to take big note of course, as a driver for the Aussie dollar. You can see then, just looking at the technicals, we've bounced off the 50-day moving average at 68.64. In fact, if we just go to the weekly, we can see this halfway point we like of the 2021 downturn, if you like. That halfway point is at 70.88. And then you've got the 200-week moving average at 70.69. So if we just go down to the daily, you can see, yeah, that sort of cap resistance on the upside there. And then we fell sharply, obviously, on non-farm payroll. But as I say, we've sort of found support at the 50-day moving average. And also another fib level, which is a 38.2 at 68.71. So we bounced quite nicely from there, but we really need to get probably above 70 or so, to then look potentially at these highs, recent highs above 71. Okay, I think we should just probably touch on one other thing, which is euro dollar. I guess we've seen a pushback really from what we saw during the ECB meeting. Sorry, just losing my train of thought. Let me just grab the euro dollar chart, which is here, that you can see. But ECB, well, going into that meeting, if you remember, pretty hawkish expectations really, and it was a really high bar for Lagarde to surprise. She didn't do that really, and she failed really to keep that hawkish sort of vibe going, if you like, from the December meeting, where it had really taken on a hawkish tilt, if you like. Obviously, the ECB raised rates by 50 basis points and committed to another 50 basis point rate hike in March. And kind of the sort of market reaction was, one of disappointment, really, even though we think Lagarde still tried to comment on continuity and consistency. So she referenced her Davos comments about tight labour markets, ongoing wage rounds, high core inflation, and the need for fiscal policy to start unwinding the measures. But she also said, that disinflationary process in the Eurozone, at least, had not started. But the market took it as being not as hawkish as she could have been. Even though Lagarde sort of in her own unique way, if you like, tried to say that intent is not 100% commitment, but they will be raising rates in March by 50 basis points. Obviously, what happens going forward after March, that's probably a key source of disagreement within the governing council. Again, like in the US, it's all about data now. We're very data dependent. That will be key for the ECB as well. And we should probably expect quite a public debate, really, ahead of the March meeting, about what happens after it. If the 50 basis point hike is locked in, we'll talk about that nearer the time, I guess, when we see the pricing, of course. But expect volatility in the short term. We have had some hawks, Holtzman, suggesting, in her view, the risk of over tightening appears to be dwarfed by the risk of doing too little, like we just said, actually, with that RBA meeting and some of the comments around that. So we've had a sort of hawkish retuning, if you like, by some officials after that market reaction to President Lagarde last week. And you can see now Eurodollar, you can see that sell-off sort of last week exacerbated by non-farm payroll, of course. And then we've had support again by that 50-day moving average. Interestingly, sort of dipped below there, printed a doji, so kind of indecision in a way yesterday, and then sort of a slight bid, small bid to prices today. So that 50-day moving average just below 107, 106.98. That will offer first support, and then we probably have to look at some of these fib levels. Say there's a big one at 106.10, so below here, which is a long-term fib level of that 2021 decline. So Eurodollar, you can see, actually, interestingly, on the weekly, slightly overbought. We've sort of come off that, so we've eased those overbought conditions as well. And you can see, excuse me, we were sort of long time overbought for a while, actually, pushed up there. So easing was kind of expected. And you can see now we're back below actually 50 on the daily RSI. So interesting whether we can hold around this level and then push up towards 108. If we do lose that 106.98, and then this week's low at least at 106.69, then we're looking down to 106 potentially. Okay, that's all we have time for this week. We hope you've enjoyed what you've heard. Please do register and keep with us in a couple of weeks when we'll be back for more to digest and take on. We have next week's US CPI data and UK CPI data. UK's on Wednesday, US CPI on Tuesday. Really should be a big market mover. So look forward to speaking to you in a couple of weeks' time.